Thank you very much for joining another instance of the IntoTheBlock Webinar series when we cover some of the hottest topics in crypto. Today, we're going to talk about DeFi trading strategies, which is triggering a lot of interest around the quant community, around the crypto community. Specifically, we're going to cover the new and emerging opportunities in DeFi quant strategies, but also the risk. So we want to introduce some ideas in terms of how to think, how to analyze risk when come to DeFi quant strategies, and to not keep things in purely theoretical exercises. We're going to provide a lot of practical tips in terms of how to analyze, how to think, how to execute DeFi trading strategies more from a quantitative standpoint. A couple of logistic aspects. If you have any questions throughout the webinar, please feel free to use the Q&A panel, and we'll be monitoring the questions throughout and take time to answer those as stop multiple times throughout the webinar to answer those. So this webinar, differently from others, is about ideas. So we have been doing a lot of work in terms of analytics, in terms of building different strategies and experimenting ideas in the DeFi space. And what I'm going to present today is a number of ideas, a framework around this concept that hopefully will help you think about this space. I expect you to disagree with some ideas, to agree with others, but hopefully my goal is to help you think about this space and to probably spark some debate. So it's very practical, but we're trying to lay out the conceptual framework around a lot of these challenges and opportunities. Before we do that, I want to just give you a quick update about IntoTheBlock in a couple of slides. Since in the last 3 weeks, since we did our previous webinar, many other customers have gone live with IntoTheBlock Analytics. So Femex, the derivative exchange, CoinStack, the sites as well, ECB and Nominex are some of the notable customers that are already live, and you can go to the IntoTheBlock blog and see some of the screenshots and go to this website and check the analytics. We are, we're very discreet in terms of customer numbers. We're approaching a very big customer milestone that we'll probably do some press release about it, and there's some major names in the fintech industry that recently signed agreements with IntoTheBlock that should be going live in the next 3 weeks. I know it's a little bit abstract, but we try to keep things very discreet in-house. In terms of the product, the IntoTheBlock product continues to evolve very rapidly. In the last webinar, we talked about predictions and the launch of the change flow analysis. Today, I wanted to tell you about our newest release that is going to be out before the end of the quarter and is focused on decentralized finance. So in about 2 weeks, you're going to have the richest portfolio of analytics for DeFi protocols in the market by far, over 60 analytics that cover a ton of the top protocols in the space as part of the IntoTheBlock platform. So if you're listening to this, go register, and we're going to start sending previews, invites, and things like that in the next few days. But this is part of the work that we have been doing with many quant desks, trying to understand these protocols and formulate quant strategies around them. We took some of those analytics that we're using in actionable strategies and packaged them up in a single release. Again, very, very deep, over 60 analytics, and we're adding more to it. So it's going to be the richest catalog of indicators and insights about the DeFi world in the market by far, and it's only a few days away, and you're going to see some of that throughout the session. So this is all I'm going to talk about IntoTheBlock today. Let's focus on the risk and opportunities for DeFi quant strategies in the current state of the market. Obviously, DeFi has been capturing the headlines in the crypto industry. There is a lot of speculations. There is a lot of bullish behavior in the market, but it's also it's pretty unquestionable that it's becoming a very important component, building block of the crypto ecosystem. So from the trading perspective, from the quantitative trading perspective, DeFi introduces a ton of opportunities in the current market, but also it challenges many of the preconceived notions that we have about how to analyze risk. So as you venture into this space, you need to think about risk very differently, but also there are all sorts of opportunities that are being presented that are things that we haven't seen before. So the presentation is divided in two parts. The first part, we're going to talk about trading strategies and opportunities. The second part, I want to talk about a new framework, at least some new ideas to think about risk. Let's start with the opportunities part. So some observations about trading strategies in DeFi, and again, these are some ideas that we have been outlining around the work that we have been doing. They're new. Some of them might be polemic, but hopefully will help you think about this space. So when you think about DeFi today, the rapid evolution of the space has created many short-term opportunities, like yield farming, right? That's the area that many people are playing, and unless something ridiculous happens, that opportunity is going to go away in the long term, right? Because it's an event, it's a specific event in time, it's a consequence of the evolution of the market, but it's obviously, it doesn't seem to be sustainable in the long term. But in the short term, it certainly has created a lot of opportunities for wealth. But how to think about DeFi in the long term? So if you're serious about this space, if you're formulating trading ideas, investment ideas for the long term, how should you think about DeFi today? So there are many characteristics that make DeFi unique, but most of them, when you think about it from the quant perspective, there are three characteristics that we think make DeFi very, very unique. One is that it's fully observable. So everything is transparent, everything is logged in public ledgers. And that's even the playing field between really sophisticated funds that have access to a lot of data and those that don't. Here, all the data is mostly publicly available, and it's certainly not equal, but it certainly acts as an equalizer. Is the opportunities for formulating strategies for the small players and the big players are pretty much the same. The second one is programmability. So the idea that you can create programmable building blocks end to end is fascinating. And the third one that might be controversial is, I couldn't find a better term, but we often refer to DeFi as a regularly inefficient market, and we're going to talk about that. So let's go one by one. Fully observable means that every single trade in DeFi, every single transaction, even the ones that don't commit, are recorded in blockchain. So you have access to a lot of data in order to extrapolate intelligence from this. Furthermore, you can actually, for many strategies, the ones that are statistical or arbitrage based, you can accurately estimate how much money you're going to make or lose in the case that the strategy doesn't go through, which is conducive to creating all sorts of simulations that are impossible to do in traditional capital markets. So pretty much before we execute an arbitrage trade, we have a pretty good idea of how much money can be made and what's the cost of execution that might be lost if the trade doesn't go through. That's something that you cannot do today in traditional markets, and DeFi offers that possibility. When you think about programmability, this is by far probably the most important characteristics of DeFi. The fact that the building blocks of the market are exposed via programmable interface, it takes quant strategies to a new level, because now you can execute strategies that go end to end, from evaluating an opportunity to triggering an execution to borrowing money to placing some insurance contract, all in a single atomic block. And this is something that is completely impossible to do by traditional CeFi or traditional capital market interfaces. So this is something that the complexity, the sophistication of quant strategies in this world is likely to be a multiple higher than what we're seeing what we're seeing. Now, obviously, everybody's focused on arbitrage. So from the execution standpoint, the strategies today are very simplistic. But in terms of the building blocks that are available to those strategies in programmable interfaces, they're completely unique. So we have the possibility of creating a new generation of strategies that we haven't seen before. Now, the third point is what we call regularly inefficient markets. So if you think about efficiency in traditional markets, take any of the traditional capital markets, as the market evolves, they tend to become more efficient, and therefore the asymmetries in the market sort of dissipate. And that's a way that traditional financial markets work. In the case of DeFi, the market is inefficient, but it's not only inefficient because it's new. We don't think there is a possibility that inefficiencies in DeFi will never go away, because inefficiencies are a key part of DeFi as an ecosystem. So as long as you can fork protocols, introduce new protocols, build protocols that encompass, that include arbitrage as a first-class citizen, we're gonna see swings in efficiencies in the market. It's gonna become more efficient for some time, and then more inefficient, more efficient. And then over time, it gains efficiency little by little, but you're always gonna have these cycles. Again, this might result polemic, but when you look at the current architecture of DeFi market, there's some fundamental things built in that facilitate inefficiency and have nothing to do with the fact that the market is new. So the opportunities for arbitrage, concepts like AMM, are not going away as the market evolves. So they might change, they might evolve, but they're not going to, it doesn't seem that they're going to disappear in the medium term. Again, this might be controversial. This is a way that we're thinking about it right now. So how should we think about the opportunities in DeFi? So there are three, if we need to model out the life cycle of opportunities in DeFi from the perspective of quant trading, I can think about it in three big buckets. One is event driven. A new protocol launches, a new token launches, we can yield farm it. That's what's happening with yield farming today. It's one event in time, and you can take advantage of those opportunities and make a ton of money. But those are likely to go away. It's like event driven in capital markets, like acquisitions and a spin-off. You know, they do happen, but they're few and far between. Obviously, we're not expecting a new protocol to live in a market in which new protocols and tokens are being launched every day, because that's unsustainable. The market should settle on a few key protocols and assets, and that's a way that is going to evolve. So event-driven opportunities are dominating the space today, but are likely to go away in the medium term. From there, we move into arbitrage opportunities, in which the edge is very much the speed of execution. I can place my orders faster than you. And maybe I have some intelligence edge. That's important, but the speed of execution is very important. Like for instance, arbitraging between different dexes. And then eventually you move into a world in which intelligence gives you the edge. You're arbitraging between CeFi and DeFi, between derivatives and DeFi. Then things like predictive models and more sophisticated thesis is what is going to give you the edge. So, and that's obviously, as time evolves, we move towards more intelligent strategies, but the size of individual opportunities is going to decrease. You're not going to find that token that you can yield farm for a while and make a ton of money. The number of opportunities is going to be wider. The size of individual opportunities is going to be smaller. And that should be a sign that the space is evolving. So we think this framework sort of works. I mean, we like sort of as a way to think about the life cycle of quant DeFi strategies. We think there's some merit to it. Now, when we think about the current generation of quant DeFi strategies, if we want to simplify this, although there is a taxonomy that also we believe is relevant. So you can have strategies at a single protocol level, some arbitrage in Uniswap. You can have opportunities across strategies across multiple protocols, and you can have opportunities that go between CeFi, DeFi. Pretty much any quant opportunity a strategy that we can think about it fits one of these three buckets at the moment. It might change. And today there are massive opportunities in all of them. So let me try to illustrate that in a few practical examples with some sample trades. So for instance, in the single opportunity arbitrage, one trade that happens all the time is very basic arbitrage in Uniswaps, in which you can find different in prices between different pools in the same exchange, in the same AMM, in this case, Uniswap. So in this case, this is an actual trade that is illustrating a swap that started with 349 Ether and went to USDT, then from USD went to the USDC pool and converted the USDT to 163 USDC, and that USDC got converted into 384 Ether. So this trader was able to make 35 Ether in a single transaction, in a single swap, in a single exchange. And those type of opportunities exist. And you need to be fast, you need to identify, to execute, to know how much gas you need to, but they do exist. Now, obviously, they're very competitive and they don't require a ton of intelligence. So that's a lowest hanging fruit for traders. Then the second level is on multi-protocols. When you start combining multiple DeFi protocols, and for instance, that same idea that I gave you, we can extrapolate it to multiple automated market makers. Let's say between Uniswap and Balancer, Uniswap SushiSwap, Uniswap SushiSwap and Balancer, and try to find price inefficiencies between those. So in this case, there is this trade that entered with 6.5 Ether on Uniswap, and then it converted that in Balancer to 6.66 Ether in a single transaction. So it arbitraged between multiple DEX at different AMMs, just looking for price imbalances between pools in Uniswap and Balancer. And this is also a common trade that happens, and you can extrapolate that concept to Uniswap, to SushiSwap and other DEXs, and expand that that realm of opportunities of finding price imbalances between all of them. And obviously, this one requires a little bit more sophistication, right? You need to analyze all those protocols. You need to and you need to try to know how to execute very fast. I hope this is making sense. Remember that you can use a Q&A panel if you have any questions. Another example of DeFi arbitrage. So this is an example of Ampleforth. So Ampleforth, as you know, is a semi-stable coin, maybe a good way to label it, that that programmatically alters the circulating supply every day. So when that happens, there is some DeFi exchanges like Uniswap update the price immediately, and other centralized exchanges like Coinbase or Bitfinex take longer to do. It's not that simple, but that's that's the essence of the trade. So if you're able to forecast the change in price of Ampleforth, you can arbitrage very efficiently between a centralized exchange and a decentralized exchange, depending on how the circulating supply changes. And these are examples of trades that are happening every day right now. Now, these are relatively simple. They do require some engineering talent to pull it off, but they're not particularly sophisticated from the predictive models standpoint and things like that. So some ideas that we're exploring, and again, this is very early for us. So we're looking at flows of transactions in automated market makers to try to identify predictive patterns. Like if I can predict swap flows in specific pools in Uniswap, how much intelligent can my arbitrage be? At the same token, the combination of predictions and arbitrage is very interesting to us. So if I can forecast the price of Ethereum and BAT, can I go to Compound and do an arbitrage that is more efficient? And then there is this notion of smart liquidity providers. That is, suppose that you're not an active trader, but you have a large pool of capital that you would like to earn a yield in one of these AMMs. So the brute force way to do this is you find a liquidity pool that is very active. You say, I'm gonna put my capital there, and you might own about 30 basis points on Uniswap based on the volume. A smarter way to do this might be to have an algorithm that takes your capital allocation and scan all the available pools and tries to come up with a distribution that maximizes liquidity based on volume and volatility. So let's say that I want to deploy $2 million in Balancer. It could be scanning the pools and say, put 500K here, 750 here, this, and that, and then rerun that algorithm multiple times during the day and rebalance my allocations in order to maximize the yield. And this is like a DeFi version of portfolio allocation, the high frequency portfolio rebalancing type of thing that with the use of predictive models, it could really become very interesting. So we're exploring all sorts of crazy ideas like that. So in terms of trading strategies, some takeaways. DeFi takes arbitrage to a new level. I'm not the most pro arbitrage person, because most of those opportunities go away in the long term. But with DeFi, you have the opportunity of architecting arbitrage strategies that we've never seen before, like multiple protocols and between CeFi and DeFi, and all sorts of intelligence baked in that is really hard to do in any other asset class. Concepts like automated market makers are not going away, and that's going to continue going for the long term because they are one of the cornerstones of the DeFi ecosystem. Programmability and regular inefficiencies are going to be part of this market and opens all sorts of opportunities for DeFi strategies. And the opportunities are not only for active traders, so also for passive investors in order to do smart capital allocations are also super interesting. So now let's talk about risk. So the opportunities are there. You can make a lot of money with this, but risk takes a different connotation from what we traditionally know in capital markets. So when you think about quant strategies, the way that we factor risk in quant portfolios is very related to either when you're doing a very active alpha or smart beta strategy is very based on portfolio theory. I mean, it's a flavor of it if you wish, but that doesn't apply to DeFi. When you're thinking about DeFi, you need to about risk in DeFi strategies. You need to think about all sorts of things that are completely foreign to risk management in portfolio theory. Let me give you a few examples. So for instance, protocol failures. One of these protocols has a bug that cannot evolve, or it cannot scale past certain point, and then all your strategies are stuck on that. Forks. I mean, we just saw the SushiSwap, Uniswap drama. So all these protocols are forkable, and those you can, with very little effort, you can fork one of those protocols and trigger a liquidity attack, and that introduces risk into your strategies. Front running. I mean, miners see all these transactions in the DeFi world. If the strategy is trivial enough, they can front run your transaction. And obviously, the more sophisticated the strategy, the more difficult to replicate. And if they're not analyzing a smart contract, it's not like looking at transactions. A miner can figure out exactly what's going on. But for very simple arbitrage transactions, it's very easy to figure out. Liquidity attacks. Again, going back to the SushiSwap, Uniswap example, any of these protocols can trigger a liquidity attack on another one of these protocols and try to extract liquidity from the target protocol and affect trading strategies. The cost of execution. So the cost of gas is something that it should be considered when it comes to DeFi strategies. I left one of the most polemic ones for last, decentralized governance, that is sort of the concept that rules many of these DeFi protocols. Is very tricky when it comes to manage risk. So suppose that you're trading in a specific AMM in one of these protocols, and there is a governance proposal that is going to make a drastic change that is going to affect the way that you conceive your strategy. So that's a risk. There are many good things to decentralized governance, but it does introduce a lot of risk from the trading perspective. So I gave you some practical tips about trading strategies. Let me give you some practical tips about risk mitigation, some of the things that we have been doing. So for instance, one of those is related to efficient gas management, which is something that any trader in the space is a victim of. So if you're going to execute a strategy, you need to know how much you're going to pay for it, because if this transaction fails, you need to pay for the cost of execution. So the obvious thing is to pay more than the other guy, but how much more? So if you pay too much, even if the transaction is successful, you might lose money. If you pay too little, somebody might overbid or front run your transaction, and then you're left with the cost of execution. So a trick that is very, very unique in this space is what is called self-destructive smart contracts. So these are smart contracts that allocate a space for data structures, and obviously and that requires gas. And then when the gas is cheap, those contracts are self-destroy, and the Ethereum network returns, they receive gas in return for releasing that space. So the trick is you can create a bunch of dumb smart contracts that are just sitting around consuming space. And when the gas is cheap, you destroy them, receive the cheap gas in return, store it, and then when you're going to execute your strategy, when the gas is more expensive, you can overbid others with the cheap gas that you receive as part of the self-destructive smart contract. It's a very hacky way to handle this, also a very practical tip. It does require obviously the hard part to figure out is when gas is cheap versus expensive, right? And for that, you can use some trend following, trend analysis strategy, sometimes serious, simple trend time series predictive models. This is one visualization that is going to be part of the DeFi, the IntoTheBlock DeFi release, in which it's giving you a heat map of the cost of gas day by day, hour by hour. So you can, by looking at this, you can start extrapolating some patterns in terms of the cost of gas in your execution. So some takeaways from risk management in terms of DeFi strategies. DeFi requires a new risk management methodology. So nothing that we have, not even in CeFi or traditional capital markets applied to DeFi. You need to consider all sorts of factors that are foreign to most risk management methodologies. And decentralized governance is sort of a wild card, right? It's one that you cannot plan for. And it is one that you need to be monitoring all the time. I mean, we have some very dramatic examples with what happened with Maker and things like that, of how a decentralized governance, call it hiccup, right, could have a big impact in the protocol. Again, so a quick summary of what we have discussed so far. DeFi offer obviously a ton of new opportunities for quantitative strategies. The strategies, the way we see it, should evolve from event-driven to high frequency to more like some with an intelligent edge. And obviously risk is completely different. So if you're playing in the DeFi space, you need a new methodology for how do you quantify and how do you assess risk across a portfolio of quant strategies. This is all I wanted to share. In the next webinar, we're going to continue with the DeFi trend, and we're going to give you a ton of analytics about automated market makers. So we're going to look at some of the top protocols, Balancer, Uniswap, SushiSwap, and we're going to give you a ton of insights that take us into the world of AMMs. The link for the webinar is in the chat, so you can please go and register. It's going to be a lot of fun, and we're going to share a lot of the analytics that are going to be part of the IntoTheBlock DeFi release. With that, I would like to open for questions. I don't see any questions in the Q&A so far, but if you have any questions, please feel free to use the Q&A panels. So Fernando Villar is asking, what are the platforms and language used for DeFi strategies? So obviously, because part of this executes on chain and the bulk of DeFi is Ethereum today, you do the execution in Solidity, but everything that is off chain. I mean, we tend to favor languages that are very data science friendly, like Python or so, but all this strategy has an off-chain component in which you have a ton of flexibility and an on-chain component that you need to rely on a smart contract language like Solidity. Yes, Anonymous asked, could I briefly elaborate on the gas accumulation and self-destructive smart contracts? So this is a trick on the Ethereum network. I mean, it's well known. It's not that we invented anything here, but so you can create a smart contract, and that smart contract is going to have data structures that require space. The Ethereum network, as an incentive for not using a space, for not wasting a space, rewards efficient smart contracts with gas. So the trick is you create those smart contracts, then another smart contract destroy those smart contracts, calling the destroy method. And then the Ethereum network issues gas. If the gas price is cheap, you can accumulate that gas and then use it into once the gas is more expensive, when you're going to execute the DeFi strategy. Joe Rell is asking, which DeFi strategy info would you provide on your website? We don't provide trading advice. We're going to release about 50, 60 DeFi analytics and indicators that you can use on your own strategies. In our blog and in other publications, we're going to be documenting, doing more exercises like this, like putting ideas for trading strategies and things out there. We're not trying to build trading bots or things like that. But what I can tell you is that the analytics that we're releasing, about, let's say, 70% of them are the same analytics that some of the most sophisticated quant desks in this market are using in their DeFi strategies. So we're trying to make those available to everyone, and they do not exist in the current market. Anonymous again, or different Anonymous, do you believe Ethereum will decrease the price of gas soon? What will happen in terms of security? I don't know. I mean, there is obviously that's a good balance, right, between the price of gas and security. What I can tell you is that the price of gas, which is obviously skyrocketed because of all this silly arbitrage, is becoming unmanageable for many protocols. Forget about DeFi for a second. Like, people that are building applications on Ethereum that need to deal with this, the price of gas is becoming a huge bottleneck. So there are different ways to deal with this. I think there was a recent podcast by Vitalik, maybe with Laura Shen, in which he alluded to different solutions that this could, in which this could be solved. Obviously, one of them that is very tangible is that the AMMs become more efficient in terms of managing arbitrage and things like that, because today the AMMs encourage arbitrage, but it's not a trivial thing to say, which also opens the opportunities to other blockchains to build DeFi protocols that compete with the ones that we have in the Ethereum blockchain. And there's some interesting protocols like Algorand, like Ontology, like others is trying to ship technologies in that space. Obviously Binance, right, is trying to ship technologies in that space. Are there any quant started using instead of gas to be considered? I have to assume so. The quant, there is not one that comes to mind, but I have to think, just statistically speaking, that yes. Alex Murphy, how much do you think protocols aim at eliminating arbitrage will impact these opportunities? Curve, Pico, Uniswap, all of them. Not much. So two parts of the question. If you're referring to arbitrage opportunities, the way to think about it is, so let's assume that not all quant strategies are arbitrage. Arbitrage is the most simplistic form of quantitative strategy. So this is what we're doing now. But as I mentioned, it should gravitate towards the strategies that use more intelligence. So protocols like Uniswap and Curve and all that, they try to minimize the impact of arbitrage, versus protocols like Uniswap and Balancer that try to maximize, not to maximize, but that include arbitrage as a first-class citizen. So I think there's going to be a balance on the two. I don't see a world in which the arbitrage protocols go away. I mean, it's just too lucrative. And there is something to be said. I'm intellectually intrigued by this notion that arbitrage is just a native part of the protocol of how much can you do. So I think the two are going to coexist. Now, what I do think is that in the long term, the bigger opportunity is going to be in strategies that use more predictive concepts, machine learning, and all that, and not brute force arbitrage. I think that's it. So if any other questions, feel free to use the Q&A. The link to the webinar is in the chat. It's in the chat window, so please register. And I think there are just no, I think there is no other questions. So I would like to conclude today's webinar. Here's my information. You can contact me through Medium or just drop me a note at jr@IntoTheBlock.io. Thank you very much for joining. The next one is going to be fun. It's going to be about insights about AMMs, a lot of cool analytics that you haven't seen before. Go sign up for ITV, send us some feedback. If you have ideas about DeFi, we're all learning here, so I would love to hear from you. And again, thank you very much for taking the time to join us today, and I hope you like the content. Thank you.